First learning objective is to explain accounts, journals, and ledgers as they relate to recording transactions and describe common accounts. The accounting process. The first step in the accounting process is to record transactions in the journal. Transactions are economic events that impact the organization. The journal is simply a chronological record of these events as they occur. Okay, so if we have 5 transactions during the week of June the 1st, we would expect to see them in the order that they occurred. Okay? At various times, we would copy these transactions or post them to the ledger. Okay? So, posting is simply transferring information from the journal to the ledger. Okay? And the ledger is simply organized by account. Okay, so we're taking information that occurs in the journal, we're posting it to the ledger, which summarizes the transactions from the journal. The third step is to prepare a trial balance. Now, a trial balance is simply a listing of all the accounts and the amounts that the accounts contain. So, if there's activity in an account, it should be found on the trial balance. If the account has no activity, then it has a zero balance, then we shouldn't see it on the trial balance. An account is a basic summary device. It's a detailed record of increases and decreasing in specific assets, liabilities, or owner's equity during a period. Okay? So it basically shows the beginning balance, the transactions that have occurred during the period, and an ending balance. As we said earlier, the journal is a chronological record of the transactions that are organized by date. At various intervals, we update the ledger by transferring information from the journal to the ledger. Okay, it can be a book, or like everything else, it can be computerized. It contains all of the activity that's taken place within the account. We'll talk about specific organization a little bit later. The trial balance, we said, is a list of all the accounts and their balances. As the name implies, the trial balance should be in balance. And we'll talk about that in depth in a little while. Okay? We talked in Chapter 1 about the accounting equation. The accounting equation will always be able to assist you no matter what kind of an accounting course or work you may be doing. We said that we've got 3 broad categories: assets, liabilities, and owner's equity. Assets. These are economic resources that benefit the business in the future. What are the examples of assets that we have? Cash, accounts receivable, notes receivable, prepaid expenses, land, building, equipment, furniture, fixtures, computers, vehicles, delivery vans, anything that the company will get a future benefit from. Okay, so let's go back and talk about some of these. We all know what cash is. Accounts receivable is credit that we extend to our customers. They buy our product or service, we let them pay us at a later date. A note receivable is similar to an accounts receivable, except that it is loans the business makes to individuals, not customers, but to individuals. Prepaid expenses are expenses we pay in advance. If you have insurance, many insurance companies require that you pay them in advance for a 6-month to a 1-year period. If you've got very little credit, you may have to prepay your rent. Another example of a prepaid expense is supplies. It's an economic resource that you buy, say at Staples or Office Max, and you use up over time. Land is simply something that we may be holding for an investment for the future, or that our facilities are currently on. Okay, building, we know what that is. Equipment, furniture, fixtures, computers, copiers, machinery, things like that. Vehicles, cars, delivery equipment, items along that line. Okay? Liabilities. We said earlier that liabilities are the creditor's claims to the asset. Liabilities are simply debt. Okay? Accounts payable. These are monies that we owe to our suppliers. Just like we extend credit to our customers, our suppliers may extend us credit. We buy their merchandise or their supplies. We pay them at a later date, usually within 30 days. A note payable are monies that we borrow from a bank or other type of lending institution for something like equipment or a vehicle or a planned expansion. A mortgage would be an example of a note payable. Accrued liabilities are expenses that we've incurred but not yet paid. For example, salaries. If our employees are paid every 2 weeks and this is the week we don't pay them, we record the salary expense and also we record the accrued liability. It's an expense we've incurred but we have not yet paid. Okay? Taxes and interest would be something similar to salaries. We've incurred the expense but we haven't yet paid it. Okay? Owner's equity. We said that owner's equity is the owner's claims to the assets. The capital is the net amount invested by the owner. Withdrawals are the monies that the owner takes out of the business for personal use. Remember, we said earlier, owners do not get a salary, they get a withdrawal from the business. And of course, under owner's equity, you've got revenues and expenses. These are earnings coming in for services or product that we've sold, and these are expenses going out, expenses that were generated in earning these revenues. Okay, so here's a nice graphic illustration. All individual accounts combined make up the ledger. Remember, we said the ledger was a book, and it simply, the accounts are combined together to make up the ledger. So you'll have your cash, your receivables, prepaid items, your long-term assets, such as land, building, equipment, followed by your liabilities, followed by your equity, your revenue, and your expense accounts. So the flow of the ledger is assets, liabilities, owner's equity, revenue, and expenses. That's the way the accounts flow in the ledger, and then also that's the way the accounts would flow on the trial balance